Canada's economy saw no growth in November, and once again, somehow we're still technically not in a recession. But if this doesn't feel like a recession to you, you're not imagining that. Now, November GDP of last year, that's the most recent reading, came in flat, zero growth. But under the surface, Canada's splitting in two. Services are still growing, but goods producing industries are quietly contracting. And a lot of this is stuff that's related to housing. Manufacturing is down, wholesale trade is down, forestry and agriculture are down. Meanwhile, retail rebounded, education came back, transportation recovered from strikes, which is mostly your Canada Post. It's obviously not a sudden downturn, but it's a lagged housing slowdown that's working its way through the economy. And it explains why GDP can look fine, but why people feel broke and why 2026 almost depends entirely on housing and investment. Let's break it down. And as always, if you want macro explained through housing, not headlines, hit the subscribe button. Real GDP was unchanged in November after a 30 basis point decline in October. It sounds boring, but it isn't, because this could lead us towards the second quarter of declining GDP in 2025. But there's a bit of a split going on here. Goods producing industries are down about 30 basis points. Service producing industries are up about 10 basis points.